Let's address another set of numbers. The Bharat Forge came out with numbers earlier on. Mr. Amit Kalyani, Executive Director, joins in to discuss the internals of those earnings. Mr. Kalyani, it's great to have you on the show. Let's start off with what was the highlight of this quarter for you?
So the highlight of the quarter was, we've had, I think, one of our highest, strongest operating performances ever. We've had sales of almost 1,460 crores. We had a very strong EBITDA. We had an EBITDA both in terms of margin was strong as well as an absolute. Our margin was almost 30%, 29.8%, and the overall EBITDA was 437 crores, leading to a PBT before exchange gain or loss of about 371 crores. And overall, the operating performance of the company was very strong. We see continuing strong demand in the commercial vehicle sector in India and in North America, in the industrial sectors, both in North America, Europe and in India, and driven by the recent price hikes in commodities, especially oil and gas. We expect to see even further growth and strengthening in the oil and gas business. So all these are leading to, looking at a very strong year next year. And I think we are well equipped to continue growing the business and, getting ready for the transition into the next phase of our company's future.
It's good that you clarified on the reported exceptional loss. Would it be one time? Is there a spillover impact there? Because the stock, I think, would have taken some disappointment from there. Having said that, of course, I just want to remind our viewers that Bharat Forge has had a stellar run in terms of stock price gains over the last 18 months. But even so, I think this would be a bit of a peg back. Mr. Kalyani?
Yeah, I think, probably the market has not been able to understand what exactly this is. This is a provision that we have taken for certain investments we had made in new areas over the last, these investments started about 6 years ago. We are not pursuing these anymore, and therefore we are providing for them. And these are one time, and that's it. I don't think there's anything more to it. And I would rather focus on the operating performance, which, as I mentioned, has been very strong and will continue to strengthen over the next few quarters. I think one of the big decisions we have taken and approved in the board today is that we are spending about 400 crores in a new forging and machining plant in our Baramati facility for expanding our capacity for high value products where we see tremendous demand and traction. And these facilities will start coming online in not a very long time, in a matter of 3 to 4 quarters. They should be up and running and start generating revenues. Additionally, as you know, we have announced that we are setting up a Center for Lightweighting Technology in Andhra Pradesh. We have begun work on the facility, and this also should be commissioned and up and running in the first calendar quarter of next year.
Okay. Purely by way of expectation, what about cost management in your margins? I think the street was working with a number of 30%, and that would be the new range for margins at the operating level. But you came in at about 28.5%, which is flat on a year-on-year basis. Is there scope for margin expansion?
So, yeah, let me explain the margins. There are two elements to the margin. One is that there is a steel price increase that has taken place, between last year and this year, and continues to take place. So this is a pass-through. So it inflates your top line and it inflates your cost line. But it, therefore, optically the EBITDA margins may look lower. And also we have increase in R&D expenses due to our new R&D facility in the UK. We do not capitalize any of our R&D expenditures. We charge it all off to P&L. Plus we have a exchange loss this quarter versus an exchange gain last quarter. These are all notional based on the rupee dollar at the end of the quarter, and these are the reasons why the margins look lower, because these have largely been in other expenses. And if you were to take these away, aberrations away, in fact, I think our other expenses as a percentage of sales has come down compared to the previous year and the previous quarter.
Are you getting any sense of any disruptive activity because of electric vehicles? You know, as of now, it's only on paper and everybody is talking about it. But are you getting a sense that it could change the way you will do business in 2 years from now?
Absolutely. As I mentioned, we are pursuing a strategy of developing products and solutions for electric vehicles. The whole Center for Lightweighting is going to be a major player in that. Also, our Center for Drivetrain Technology is a player in that. And we believe that the electrification will happen at, in 2 steps. First will be passenger cars, then will be commercial vehicles much later. And in India, it will be in 3 steps. It will first be 2-wheelers, followed by passenger cars, that too at the higher end, and then the lower end passenger cars, followed then by buses and then possibly by trucks. And we are working with companies across the world in developing products and solutions for electric vehicles. Our R&D center in the UK is focused solely on this, on developing products, solutions, systems for electric mobility, and we're very confident that this will be a very big opportunity for our company. I'd also like to add that we are already a major supplier of components to hybrid vehicles, and we are seeing this penetration going up, and also the revenues from this sector going up quite substantially in the near future.
Amit, there's one of those days that there's so many numbers which have come out. We need to cut across to the SBI conference, but I hope that we get a chance to interact with you much more and outside the quarterly numbers as well. I don't want to wait for another 3 months before I talk to you.
Sounds good.